Welcome to today's webinar on mortgages for self-employed clients. So let's jump right into it here. How many of you have been told, I can't get a mortgage because I'm self-employed? I can only get a higher interest private mortgage. I don't have any options because I'm self-employed. Or my accountant did my taxes wrong, and as a result, I do not qualify. Statistics Canada is releasing numbers saying that 2.9 million Canadians are self-employed, right? So that is increasing significantly from a couple decades ago. We found that in doing this job, a lot of people were being underserved. They didn't understand you. They didn't understand your income. Nick Lee and I chose to specialize in self-employed because we wanted to help people like us understand their options and get better mortgages. We have been doing this quite a while. We operate out of an incorporated self-employed business, so we understand the T2s and the T1s and where your income goes and what your accountant does to strategically save you tax money. We actually also wrote the book on self-employed, so this is an Amazon bestseller, helping self-employed people. There's a chapter in there that I wrote on mortgages and your different options and things you need to be aware of when you're self-employed. Nick Lee and I also launched a training course to help other mortgage professionals understand how to help these clients better, help people like you. We've actually trained over 400 people through that training course to better serve self-employed Canadians. We're also really good at this. These are a whole bunch of awards that we've won. Not trying to brag. I just need you to know that we have been in the industry quite a while, and we're actually really good at this. The presentation I'm going to share with you today is not based on any one lender's policies because you know what? They change all the time. And what we see often is that a self-employed person will go into their bank and say, hey, I want to do this. And the bank will say, sorry, that doesn't fit our policies. And then they think that they can't do it with anyone. And that may not be the case, right? Different lenders have different policies and different comfort levels when it comes to different types of mortgages. And that's why we work with a whole bunch instead of just one. So if we think about the world where my parents bought a house, it was a bit of a different world, right? Banks were the only place to really get mortgages. Your relationship with that bank mattered. They probably knew their branch manager. I never do. Somebody new every time I go in there. Um, B lenders either were non-existent or very expensive. And what they felt like is if they couldn't get a bank mortgage, potentially this guy was their only option, right? Not great. In today's world, there are more self-employed people every single year, and there are actually lots of options. And planning with the right team is really the key to figuring out what you can do with your mortgage options. So we have all of these lenders now in our channel that we didn't have before, right? When we were talking about that old school situation, there are a whole bunch of new lenders that were not here before. So where did all these B lenders come from? Well, it gets harder to qualify each year, right? We've got the stress tests, we've got government regulations, and what a lot of our lenders were finding was that they had great clients that they couldn't approve based on their regulations. So having more contract, self-employed, temporary workers, gig workers, many of these lenders actually that specialized in A financing launched B arms so that they could better serve those types of clients. And we see more options coming every single year, which is really great for us. So with so many mortgage programs for self-employed people, we're going to focus on a couple. So there are some specialty programs for insured and uninsurable purchases that they're called like stated income programs. It does not mean you can use all your income and not claim any of it to the government. It's usually you can get about halfway between the two, depending on what type of write-offs your accountant does and what the lender's policies are. There's also some options for alternative lending, Alt-A lending, so special programs for self-employed people on the A side. We do a lot of those with Scotiabank, TD, Manulife Bank, B2B. They all have kind of some special programs that you may fit into. These kind of small business owner programs, we call them. And you also may qualify for net worth programs. So if you have a lot of savings, sometimes you don't need as much income to qualify with some of our A lenders. The reality is we're going to look at just kind of the two basic options, right? So there's a lot of special things that might apply to you, and we do free assessments, calls, chats, anything with people. But the two simplified options really are A lender or B lender, right? An A lender, for the most part, without special programs, will treat self-employed people like their employee income, right? So they will look at how much income you've made for a 2-year average after the taxes are filed, making sure you don't have any taxes owing, and they will give you the best interest rates. A B lender looks at self-employed a bit differently, right? They will look at different documents. So they may look at your bank statements, or they might be able to use some cash that you make, or they might be able to take some of your business expenses and subtract them so that your income looks higher than it does on the tax documents. These ones, they have higher rates than the A side, and they have a lender fee too. They typically charge, 1.5% is what it's going to cost you to get that mortgage of the mortgage amount. So it is going to be more expensive. So when we look at these two options, most people say, well, yeah, I want the best rate one, right? Without the fees. That's absolutely what I want. I'm going to give you a bit of a scenario to see if that's actually what we want in every scenario. So a case study, do you want to be Joe or Jane? Okay, so we're going to look at two self-employed clients. So let's say Joe is a massage therapist. He makes 200 grand a year. He's a sole proprietor, and his goal is to have the lowest rate with an A lender. Jane is an electrician. She also makes 200K. She's incorporated, and she just wants a house. Okay, so when we look at their income tax, they both claim 50K in fixed expenses. And here's what it sort of looks like. I mean, I did not do the tax calculations. I'm not an accountant. So our friends from Your Bottom Line actually did that. They specialize in self-employed accounting for people. So when we look at this, the key differentiator here is that Joe is paying $50,000 to the government in income tax, and Jane is only paying 22 because remember, she's incorporated, so she has a different structure. She can save a lot more tax money. To qualify with an A lender, Joe will actually have to pay this for 2 years in a row, right? So he actually has to pay 100 grand in income tax to be able to qualify. So whose tax bill do we want to pay? Anybody want to pay Joe's, 100 grand in taxes over Jane's 22? Probably not. Okay, so what is the minimum down payment they each need? Well, Joe will need 5% down for the first 500,000, and then 10% for any money between 500,000 and a property up to a penny less than $1 million, and 20% for over $1 million. Jane will need 20% down on a marketable residential home. So whose down payment do we want to pay? Well, it might be nicer to save that lower down payment and be Joe in this case, right? So how much mortgage money do they qualify for? So Joe will, or like, remember, they've got the same income. Joe will qualify for around $750,000 in mortgage money. Jane will actually qualify for 900,000 in mortgage money, right? Because for Joe, we need those 2 years of personal tax filing. For Jane, she just wants to buy a house, wants it fast. So guess what? We're going to use 12 months of her business bank statements, or some of our lenders will allow 6 months, so that they can look through her income, subtract the reasonable expenses. So she will qualify for more money. Right? When can they buy? So Joe, he's going to have to wait 2 to 3 years. He needs those 2 tax filings that are consistent to be able to qualify for the stress test at the very lowest rates that A lenders offer. So even though it's 2 years, when you're a self-employed person, it might actually be kind of more 3 years because you have to work and then file the taxes. So he's waiting 2 or 3 years to buy a house. Jane is maybe 6 to 12 months. Okay, so 6 to 12 months. So who wants to wait 2 and 3 years to buy a house when they could buy in 6 to 12 months? Not me. So what are the costs if they both get a $700,000 mortgage? Remember, we talked about the fees and things, okay? So let's take a look at what today's interest rates and situation might look like. So Joe will have no lender fee. right? Jane will have 1% plus maybe a broker fee. So say if they're getting a $700,000 mortgage, the lender fee might be $7,000. Probably the broker fee is going to be around $3,500. So that is an additional expense for her. The rates, so you can see that Jane is going to have a higher interest rate. Joe is going to have a lower interest rate. The amortization. So Joe is going to be stuck with a maximum amortization of 25 years because remember, he's doing a lower, lowest rate option. And so he's going to do lower down payment. He's going to have 25 years as his limit. Jane has 30 years. We actually have some lenders who currently will allow 35 years as well, but we're using 30 years because almost everybody will do that, but there could be options for 35, potentially 40, depending on her situation. And if you look at the monthly payment, in these case, with the exact same mortgage amount, yes, Jane will have a few extra fees, but her mortgage payment will be $300 lower. So like if we look at this, yes, I want the lowest rate. I want Joe's rate, but I actually want Jane's mortgage payment. So it's not as cut and dried as you may think. And if we think about poor Joe waiting for, 2 years to buy a house, what could happen in those 2 years? Well, we know that typically home prices increase over time. So he might have to save more as he goes because he's fighting with inflation to make sure that he can catch up to those prices of homes. And what if there's changes in those 2 years while he's waiting? So maybe there's government regulations. We saw the stress test. We might see changes to it. Interest rates go up and down. So that will impact what he can qualify for. And the lender preferences change. Some lenders have canceled their self-employed programs. Some lenders have said, we want to see more savings if you're self-employed. All kinds of things can happen. So it really is one of those situations where we're not really sure what could happen while you're waiting. Why do they change all these things? So that's a really good question. We always hope that changes are positive and help us, but the reality is Manulife Bank did a study that suggested as high as 72% of self-employed borrowers will default on their mortgage throughout and recovering from the COVID pandemic. And if that statistic continues to hold true as we recover, there are going to be less favorable options for self-employed borrowers just because of lenders' risk. And just to give you a perspective of how many changes actually happen, since 2008, there's been 60 major mortgage regulation changes. So not just banks saying, I don't like this, or we want to do this now, or we're canceling this program, but like from the government level. Biggest one was the stress test, but there's always changes happening. So that's also something you just need to be aware of. So something to think about is that when we're self-employed, we can either be Joe or Jane. And if you have the right guidance and you're structured properly, then time is on your side, right? And we would love to help you with that. The reality is a lot of our clients actually are both. So a lot of our clients will do what we described Jane doing here, buying earlier with an alternative, a B lender, so that she can get into a house faster. And then we will refinance, like the situation of Joe, in 2 years and get down to those lower rates. Putting her in that situation is most likely going to benefit her because the reality is if we get in a home faster, we're paying less rent. Money that we are putting away goes to the equity of our home, and you're allowed to or are capable of building net worth faster. So if you would like to have a conversation about what this would look like for you, we often do chats with people's accountants as well. Especially during tax time, we can go through, okay, here's what an A lender would need for you in terms of income for what you want to do. Here's what a B lender would do. And we can do those calculations for you. And then your accountant can do the calculations to decide how much do you want to pay yourself. If you're incorporated, do you want to pay T4? Do you want to pay dividends? What does that look like? If you're self-employed, maybe it's just that deciding what types of write-offs you want to use or not use. Do you want to put your vehicle in the business or in your personal name, those kinds of things. We are happy to help with all of it. There is no charge for any of our services. You can call us and reach out to us at any time. Our email, phone number, and our everything to book a call is all on our website at laframboismortgage.ca. I hope you found this helpful and have a great day.